Everyone, this is Finance Meets Real Estate. So we meet here every week. We have many different guests. We do networking socials as well. And so today I'm gonna do like briefer lecture on market update. So let me give you a bit of introduction about myself. And if you guys have any questions, like feel free to speak up. We're a smaller group today, so let's just have a conversation. If you want to give like your your input about the market, or if you agree or disagree with what I have here as well. So let's have a conversation. So a little bit about myself first. So one moment. So so I'm founder of RealtyQuant. So RealtyQuant is an investment and data analytics company in the real estate industry. So we are a publisher of market valuations data. So that's basically which markets are over, under, fairly valued. So that is like part of today's conversation. And we also publish properties, various property analytics data on commercial multifamily. So previously I was a financial engineer for about a decade, and I have a degree in the field as well. And I used to manage a large derivatives portfolio with colleagues. So I had a career in finance, basically. So I run this series. I also speak at different podcasts, webinar events, university lectures, virtual summits, etc. So that's about myself. So some of you guys, if you've seen like previous lectures on markets, I just want to give a little bit of introduction, because this is a slightly different perspective that perhaps other investors take. So if some of you have seen like previous lectures on markets or data-driven investing, I just want to give you like a quick intro. So some of the topics I talk about usually are like automated underwriting, condition scoring, automated valuation models, and like, so basically different like technology-driven investment techniques, right? So most of those there on the property side. Now on the market side, there is a perspective of that kind of, if you will, a fundamental investor may take, which is market valuation. So it's sort of kind of being a Warren Buffett on the market side, if you will, where you try to gauge at what level or what percentage valuation you're purchasing different markets. So that's like a topic that I've done before on data-driven investing. And in terms of picking markets, then there are different aspects I just want to kind of touch briefly that one can consider in a data-driven approach, where you want to like predict appreciation more precisely, if you will. And so predicting appreciation is kind of what an investor would do, like pick market with population growth, income growth, housing supply, etc. But doing it more precisely is kind of like the more statistical approach to it. So I've done like lectures on that. I'm just giving like a little bit of introduction. And then there is a perspective of predicting downside risk. So predicting downside risk becomes very important ahead of a recession. So I've done that as well. So based on like global financial crisis and other previous recessions. So now I'm going to touch on like, and then the third one, and I'm going to end it there, is essentially like investing in undervalued metro areas ahead of a recession. So it kind of bases on those previous two discussions and kind of makes a thesis for what my investment firm does, is investing in undervalued to fairly valued only metro areas. And so that's that. So now in terms of like a market update, so I just want to give you some of the things that I see more recently. And if you guys actually want to speak up, that would be great as well. Like I'm happy to have a conversation, or if you have any questions of like the introduction that I did so far. So so let me let me start like this. So I just wanted to give like a quick market update and relate to market valuation. So once again, what is market valuation? So market valuation is really the following. So if we say we want to predict downside risk, so if we say, or even or appreciation to an extent as well, and suppose we have the global financial crisis. Global financial crisis, very severe recession. We had declines the magnitude in the table that you're seeing, with the big declines being in California, Nevada, Arizona, and Florida. So those states experience like declines of like 40 to 60%. But if you were in like some states in the middle of like North Dakota, South Dakota, Nebraska, they had like very negligible declines of the order of 4%. So how do you go about predicting this, right? So what is driving the bigger declines at that time in California, Nevada, Arizona, Florida, and what drove the almost immaterial declines in certain other places? And so that is the basis of market valuation. So market valuation is kind of like a fundamentals statistical study that a big row is predicting a downside risk in a recession. And another row is one can base off kind of post-recession appreciation studies of those levels, different levels of valuation. But downside risk is an important one. And so ahead of global financial crisis, so this is a study based on price and income time series, and a more refined way that I do at my company at RealtyQuant is based on income, population, and housing supply. So if you think of like every housing market's growth fundamentals that most of us investors are concerned with, we want to see income, population, and housing supply growth, or you can phrase it in terms of job growth, but it all translates to those variables in the end, or housing supply, not growth, but like proper relationship to population. And so what market valuation is kind of the deviation from those fundamentals. So here, this is a model ahead of global financial crisis that I did. That was basically, okay, if we, at the peak of 07-09, by each US state, this is the percentage overvaluation different US states had. And so if you see like California, Nevada, Arizona, and Florida, they were overvalued by, in this case, 49 to 68, I guess, percent. And they experienced a very big declines, as we know, like historically. So they experienced like 40 to 60% declines. And then if you see in the middle, like some of the states like North, South Dakota, Nebraska, Kansas, Oklahoma, they were undervalued. So in those undervalued states, the decline was very small, was of the order of, the average was 4%. And so that's kind of the concept of fundamental kind of investing in markets according to fundamentals, where if you do that, you would be sort of like more shielded from downside risk in a recession. And from there are other aspects. So there are different ways to do it. I'm not going to get, these are other lectures that I've done on how you can do it with different statistical approaches. Now, one moment. So now in terms of where are some of those numbers now, as of most recently in terms of valuation, and where should we invest, and what kind of perspective, at least I have on that. So I'm going to share that in a moment. But okay, just before that, one more thing I want to show is appreciation. So looking at like investing, let's say, suppose we were ahead of, suppose now it was 06, it's not, right? Everybody expects a mild recession, and that is, that's kind of like the general consensus, right? It's hard to predict economic growth and so forth, but this let's say an expectation. But suppose we were now in 06 and we choose where to invest. We invest at different levels of overvaluation. We can invest option A in, let's say, Kansas, at -4%, or we can invest in Arizona at plus 55%. Okay, so what the downside risk that we could see and that has been experienced there is, okay, seen in a way in this table to a high correlation of the order of 85%. Now, what in terms of what happens nevertheless to appreciation, this is a study I did for investing in undervalued markets ahead of a recession. And so what this study did is, so these are 400 metro areas. So 400 metro areas bucketed according to over under fair valuation. So bucketed according to like the measure that I just showed you here. And so if you invest, so there are 400 cities. Some of them are falling the less than -10% range. So those would be very generally not very desirable markets, like Johnstown, Pennsylvania, I believe, is there right now. And in the 50 to 60% range, those will be markets like at the moment, and they've changed. It's again, there's no prejudice to which market could be in either bucket because it's different always. But let's say those could be Austin, Texas, Phoenix, Arizona, etc. So, and what this table suggests is like the more undervalued bucket you invested in, if you got a mild recession such as 1990, which is generally historically considered a very mild recession, that there was almost a non-event for real estate, or if you got a severe recession such as the global financial crisis, 10 years ahead, the more and more undervalued bucket outperforms all other ones. So the most undervalued bucket outperforms the next one, et cetera, et cetera. So this is extremely important as a finding. And so this is my own study. It's not quoting somebody else, right? It's like my own study at my company at RealtyQuant. And so this is important. So what this suggests is it's important where you buy a market. It's not just about the market being strong in fundamentals. It's important that those fundamentals are not exceeded by a percentage such as 50, 60%. And if you did buy a very strong market, it exceeded fundamentals, you would typically underperform up to a decade ahead if we got even a mild recession. Again, this is based off recession studies for the past 45 years. So we could get a different scenario, but it appears from looking at like those two extremely different recessions, one of them being utterly catastrophic for real estate, and the other one being basically a non-event for real estate, that relative performance is kind of almost perfectly ordered according to valuation, and it gives an argument for investing in undervalued markets. So now, so this is like ahead of getting even any declines in the market. I was having like these numbers, let's see, on my end, and some of the overvaluations, such as, let me give you an example, such as these numbers. If you see, I've been tracking them since like 2020. So actually beginning of 2020. So it's really like kind of like for 2 years already, kind of tracking these numbers. So it's not like something where, oh, now there's like real estate declining and suddenly come up with that. No, I've been speaking on this topic in 2020 and consistently since then. And so, okay, and so what is happening in the market now? Like today's topic is like market update. So just a very simple thing. So I just want to like kind of like show you like what I see. So I haven't had time to put any new slides about this. It's just like a very casual market update discussion. So first thing like to notice is like, so where the declines happen. So this is just zero. This is just the housing market. It's not commercial. It's not apartment buildings per se. It's just the housing market. And so if we look at like where are declines happening, so take a look at like the top states. So it's Nevada, Arizona, California is there, Utah, Idaho. There is DC is kind of a little hard to track, being not a state, but kind of like smaller geography. But okay, Washington, Colorado, Oregon. Okay, so those are pretty much the material declines. That's about it. So the ones that have dropped like 1.5% and more since roughly the middle of 2022. And so the list of those markets is very highly correlated with those states, excuse me, not markets, is very highly correlated with the overvalued states. And so to give you a perspective on that, just a moment. Sorry. Okay. I was just trying to pull like the most recent like state level market valuations data. Okay, so let me just go by something that's a little bit old. Sorry about that. So I'm just gonna show you like where. Okay, that's not gonna be helpful. Okay, just a moment. Okay, so this is overvaluation middle of 2022. So middle of 2022, ahead of declines that are here. So once again, like, so let's say filtering, like, I don't know, like the bigger declines, greater than 1%, let's say. Sorry. And then, like, which are the overvalued states? So the most overvalued states ahead of some of the very recent declines that we're seeing, that again, we don't know, we don't expect necessarily over such short term they would be in line, not necessarily. But the most overvalued states are Idaho, Arizona, Utah, Nevada, Florida, Washington, Texas. So this is the valuation that RealtyQuant has. This is, by the way, in line with other studies at Moody's Analytics. If you follow Mark Zandi, chief economist of Moody's Analytics, there's a study at Florida Atlantic University. There is a study by OECD that doesn't go so granular, and some other ones. And so, like, these are the most overall states. They're all basically Western states plus Texas and Florida, kind of high level, plus Texas, Florida, and Tennessee. So it's all like, if you look at the map, overvaluation is kind of all of the Western states, with California being the least overvalued from Western states. Very not affordable, but least overvalued. And those are different things, actually. And then plus Texas, Florida, and Tennessee. So that's kind of like where the most overvaluation is. And now where are the declines happening now? And this is overvalued to an extent, by the way, as well. So it's not like overly surprising that it's there. But it's kind of, okay, that's like just a city, right? And so, but from there, it's like the same Western states, Nevada, Arizona, Utah, Idaho, that are at the top of the overvaluation list. Idaho, Arizona, Utah, Nevada. California is there. It's extremely interesting that California is there. And California has a lot of issues with some of its big cities losing population to suburban trend. Now, obviously, it flows part of it to California as well. But that seems to be very much a fundamentals eroding issue in California, where it's not that much overvalued. And it's quite interesting. It's nevertheless declining a lot. But everything else, it's just basically all the overvalued states, Oregon, Colorado, Washington being there as well. So the top list of overvaluation and the top list of recent declines that I wouldn't expect that they would necessarily align right away is actually quite aligned. Now, where one would expect the two align, where correlation is high to like around 85%, is 4 years from now. So 4 years from now, even if you have a mild recession, typically declines last for 4 years. So that's what happened after every recession, including 1990. If you have an overvalued market, it becomes very stagnant. It's kind of dragging down for a really long time. And so that's where we expect things to be really well aligned, but that's kind of like where they've already started being aligned, which is interesting. And so that's as far as the states. Now let's look at like some of the metro areas, or, you know, basically cities, right? So where are declines happening right now? So declines, this is again zero data. So this is as of year-end 2022, December 31st, just the housing market, again, purely single family, you know, like commercial investors, they say, okay, that doesn't apply to us. I'm not so sure, because the two are correlated. Like historically, price correlation is 91% between CoStar, apartments index, and FHFA single family housing. But okay, but generally, of course, assets is different valuation method, same fundamentals, but different valuation method, right? So something like that. So, okay, so from there, now looking at where the declines are happening right now. So if you see like peak date in some of the markets already in May, June, some are even March or April, but July, but mainly around the middle of like in the middle of last year. seems to be marking a peak. Now, let's see. We don't know the future. We don't know what's going to happen, obviously, in that regard, but it seems to be marking a peak, and we don't even have a recession yet. So there is no recession in that regard. But okay, so now the biggest declines: Austin, San Francisco, this city in Idaho, Reno, Nevada, Phoenix, Boise, San Jose, Las Vegas, etc. Now, as you guys know, I've been talking. I did the lecture investing in undervalued U.S. markets, perhaps a bit ahead of these declines. And here were the most overvalued cities at the second quarter of 2022. Boise, the city in Idaho that I can't pronounce, is right there. Phoenix, okay, so where is Tampa in terms of current decline? Florida decline seems like are not happening that much yet. It's interesting. So it has very small declines in Florida so far. So that is interesting. All the other markets, Boise is the most overvalued city in America by every measure, every study of it, Moody's Analytics, RealtyQuant, Florida Atlantic University. Basically, every study has Boise as the most overvalued city. Phoenix, so Boise, Phoenix, and Austin are at the very top. So now where is, again, like looking at the latest overvaluation in cities, it has come down a little bit. Sorry. So the highest one is you see like Boise, Austin, and Phoenix are very much at the top. They've come down a little bit with some of the declines, but generally it appears declines are happening very much in line with overvaluation, with the exception of California cities. So California cities like San Francisco, San Jose, they're not overvalued. So it's extremely interesting. So California is declining, and it seems like those cities, they have massive outflow of population. So this is fundamentals eroding what seems to be happening. So their population is like massively leaving. And so it's not an issue of valuation. They're not overvalued. But California cities, together with basically everything that's overvalued, are declining right now. So that is kind of what seems to be that is what I see in terms of like some of the valuation came down a bit. So it's interesting to see, like, just a moment, like how it evolved. So it was just one moment. So if you look at it, Q3 of 2022, Boise came down to 70% overvalued, and was at 77 in this data set in Q2, and it's been increasing since basically like 30s, like being around 30+% overall in 2020, and it kind of like crept up or went sharply up, and that's been the narrative for many markets like since COVID. This, it wouldn't be intuitive, and it's not surprising. But that's where like some of these numbers that they were consistently increasing for the past 2 years, they now declined. So overvaluation kind of declined with prices declining. So what can we expect from here is a very interesting question. So here is predicted declines in a kind of severe recession and predicted declines in a very mild one. So this like purely based off like historical recessions of global financial crisis in 1990. Global financial crisis, nobody expects, right? Nobody expects anything like that. Nobody expects a severe recession for real estate. But in theory, just for the record, like what is the worst case of something that reached peak overvaluation of 77%? It's kind of like prices going in half. But a mild recession decline for the same very high overvaluation is only 19%. It's actually probably better than most people even expect now. Many people who are not bearish in any way, they seem to expect like potentially bigger decline. And what drives that is quite interesting. And so those are like, let's say, predicted declines. Severe recession, let's say 30 to 40%, and then mild recession like 10, 15%, right? In the very overvalued US cities. Now, what happens at the bottom end of the spectrum? So suppose you are in something like Chicago that is fairly valued. So it has like a severe recession, global financial crisis, 9% decline predicted, and a very mild recession, 3%. And generally, so metro areas, even in a global financial crisis that were undervalued, such as the whole set here underneath, like places like, I don't know, Elmira, New York, and like sort of not very attractive markets in a way. So, but those places that were undervalued, they generally declined even during the global financial crisis, very, very little. So typically, like the average was around 6%. So it's very recession protected in some of those markets in this regard. And then in a mild recession, like a 2% only decline. So, so that's kind of interesting. And so what drives, and some people will say, like, is that for this forecasting, let's say here, the prediction part is the overvaluation is already built into the market. So the overvaluation is there now. Whether we get a scenario such as the mild recession in this table to the left, or the severe recession to the right, that appears to be, my understanding from looking at the data, appears to be a function of economic growth. Kind of a very simple answer, but not a function for global financial crisis is a disastrous event for real estate because there were all those securities issued before that and kind of credit given loosely left and right. Credit was given loosely left and right, and that drove the high degree of overvaluation. But overvaluation could happen for other reasons, such as inflation now. And if we, by the way, the current level of overvaluation in Q2 2022 at US level, in the model that I have was 19% overvalued, 19. OUS 19. Doesn't sound so high, but this is the highest ever for the past 45 years after 06 of plus 20%. So it is the highest level of, second highest level of overvaluations after 06 at any time, because typically real estate was undervalued even through the majority of history, through the majority of like almost half a century. Most of the time was actually undervalued and not even fairly valued, which is quite interesting. And so we have like the second highest overvaluation. But are we going to get big declines? No, not necessarily. In fact, nobody is expecting this. And there are also fewer undervalued cities now. Like the undervalued MSAs, like my company, I want to invest in undervalued metro areas now. There are very few. There are not that many deals on the market side, so to say. And so that is interesting. But what drives whether we get, if we have a market that's 50-60% overvalued? So two comments. So I already mentioned the relative performance. It's not just a question of like many investors, they say, I'm going to still invest. So Austin is somewhere now around 60%, right? 60% overvalued. So investors say, I'm going to keep investing in Austin. It has like all these super strong fundamentals. I want my market to go 40% up. And then maybe it's going to decline 10, 15% in a recession. I'm okay with that because my market keeps going up so much. That's not consistent with what the data suggests. Because yes, sure, if you invested 2 years ago and you rode that appreciation and now you're okay with the 15% decline, that's perfectly okay. But the question is, where do you open new positions, right? Are you rebalancing towards other markets for new acquisitions? That is really the question. And so for new acquisitions, are you going to invest in a market that's 60% overvalued? And what kind of appreciation would you get there? Well, likely you would be, even if we get the mildest recession, even like 1990, you would be getting the worst appreciation from any other place, pretty much. That is what this suggests. The example here, ahead of 1990 was Hawaii. Hawaii was booming to like triple-digit appreciation, but it was overvalued to like close to 50%. And Hawaii, 8 years later, prices were 15% lower in 98. So if whoever invested in Hawaii at that time, that was just not a good level to buy Hawaii. You just bought it too high, So that's all. And so really like appreciation is very affected from where you buy the market. it's why it's important to track this ahead of at the points where market cycle changes, because at the rest of the time mostly doesn't matter. In fact, ahead of and there are studies actually in this presentation that I did before that actually ahead of the end of a market cycle, 2-3 years ahead, the more overvalued market you buy, the more appreciation you get. So it's actually even overvaluation correlates positively with appreciation. But the moment even the mildest recession gets registered, overvaluation correlates highly with underperformance. And that's seen in this table. Because if we get a mild recession or we get a severe recession, the more and more overvalued buckets perform worse. And this is very counterintuitive. And that's where investors now who buy to the West, onto the South, they find it hard to understand how can you have a market like somewhere in the Midwest, let's say, outperform Austin, Texas, or Phoenix, Arizona. It's never going to happen, right? That's kind of the thinking. But it's really, the reason is there's overvaluation that's already built in the market that's measurable. It's not about forecasting the future or, oh, we all don't know the future. We don't know the future, but this is already there. This is already reflected in the market. It's measurable. It has predictive power. And from there, the part that is hard to forecast is, well, for instance, how big the decline is going to be. So are we going to get this recession, 1990, mild one, or are we going to get a severe one? And the answer to that is, it's a difficult one, and I don't have it. The answer is, goes through economists modeling economic growth. And economists are not particularly good at it, as we know, but it comes down to how strong the recovery is in a recession. Where if we have like a mild recession, declines, if you see in overvalued markets, took 4 to 6 years. If we had a severe recession, declines in overvalued markets took 4 to 6 years again, irrespective. And so it takes a very, very long time for overvaluation to resolve following any kind of recession. And since it takes 4 to 6 years, over those 4 to 6 years, the question is, do you get high growth, such as all the fundamentals, incomes pick up, and your prices end up declining very little? So you have, let's say, a 50% overvalued market, your prices decline only 15, only 1.5. It's because you had a strong recovery. Because real estate is not, it doesn't decline sharply, really. There's never a crash. It is actually more of like slow, steady, gradual decline. And that slow, steady, gradual decline taking a long time kind of catches up. The fundamentals catch up over this time because we have a strong recovery. So the real prediction, whether we get in a 50% overall market, whether we get a 15% decline or we get a 50% decline, is really this. It's really economic recovery. And global financial crisis had one of the weakest economic recoveries. So according to, for example, Pew Economic Research, for 2 centuries. So it's one of the worst, weakest economic recoveries over the course of 2 centuries. And so therefore, like basically incomes, they declined and they didn't recover for a while at all. And so growth fundamentals, or they didn't happen, they didn't compensate at all. And so you got the full degree of overvaluation was kind of wiped out on the price side. And so this is really like the part where that will be forecasting that, okay, you don't know what's going to happen. But from there, like, as far as do you want to buy like a higher level of valuation or not, it's something that's already built into the market. So that's kind of like my perspective. So just kind of like wanted to give a quick update and kind of share, okay, where prices have been moving recently. So all of the other states, again, that are not overvalued, such as the top ones here that are declining, basically each and every state has a degree of overvaluation, and the most declining ones are the most overvalued states. Extremely easy to predict. Have known Idaho, Utah, Arizona, and Nevada, have known those and spoken for those for 2 years. And again, like, they appreciate, which is also expected. So the more overvalued they are, the more they appreciate ahead of the end of a cycle, but then it becomes an issue or a relative performance issue after this. And so that's like where the clients have been on the state level, and then on the metro area level, as I mentioned. So like, again, some of the most overvalued cities, Austin, Reno, Phoenix, etc., performing the worst. So this is just housing market update. It's not on commercial. I know like many people have been seeing like negative rent growth. It's very interesting because, okay, when rent growth was 20%, and most of the firms thought they should model a 5% rent growth instead, and that's reasonable. But then turns out that's probably like actually not very good modeling skills, because apparently they had to be modeling negative rent growth, right? And that's probably like what's reasonable. I don't look at that topic too deeply, but perhaps it was something that one could foresee, as far as I would think, as far as the rent growth side. And so now rent growth being negative, rent growth is a big driver of cap rates. It's a huge driver of cap rates. The high rent growth is what kept cap rates from not expanding when interest rates were rising. Where, you know, sometimes like investors, they would say, okay, like cap rates ought to expand when interest rates is rising, which is not true at all. They don't, and especially a big reason they don't, it's rent growth. But rent growth now being negative, interest rates perhaps coming down though a bit, but still at a relatively high level. So it seems like that's kind of foreboding cap rate expansion. Now, is commercial real estate or commercial multifamily more or less overvalued than the housing market? So I do commercial multifamily now, but in terms of commercial multifamily investors, they typically say it's like very recession resistant. Sure, yeah, your revenue stream is more secure than most other businesses in a recession, no question about that. But is it recession resistant from price declines? I wouldn't think there is anything. There's no asset that's protected from price declines, and the fact that it declined less after the global financial crisis than the housing market did, well, that was perhaps because overvaluation was higher then on the housing market side, on the single family side with excessive lending and so forth. Now, is overvaluation now higher on the housing market side? I don't know. I'm seeing high overvaluation on the housing market side intuitively from speaking to people, and like some of the returns seen in Western markets, I would expect higher overvaluation on commercial multifamily side intuitively. It's unknown because there isn't like, even in CoStar, there just isn't like high quality price data for commercial multifamily that you can use to actually model anything comparable to that, to what is here. And so that is really that question. So I just kind of want to give like a perspective on what I see. So once again, let me just share one more thing. So once again, if you guys are interested more in like data like this, do make sure to go to, just a moment. Do make sure to go to realtyquant.com/analytics. So we publish this data for 3,000 US counties, basically all US. So we are the most comprehensive coverage out there for US for real estate market valuation. I teach a course on data-driven real estate investing, and I have a YouTube channel as well. So make sure to check that. And yeah, so with that, if you guys have any questions, like I'm curious to hear like what you guys are seeing in the market. I know it's kind of like evolving, and there are many great opportunities now. I'm doing my own projects now, so being pretty active. There are many good opportunities, but I'm just curious what you guys have to say. Sorry, I'm gonna just leave this slide about the current market, or if you want to like put any questions on the chat, that would work too.
Hey, Stefan.
Yeah. Hey, Scott, question. What's up?
Oh, sorry for the dog.
I think I can't hear you, Scott.
Oh, hello?
I think your mic is off maybe, or something. Maybe something with the headphones. No worries.
Let me see. Is that better? Can you hear me now?
Sorry, my bad. No, okay. My sound turned off. Okay, excuse me. Sorry about that. You're good.
Oh,
I think everybody can hear. It's only me.
Okay, so you can hear me now.
Yep. Yep. I can. Everyone can hear. It was only me. Yeah. Go ahead. Sorry.
Hello?
Yeah, I can hear you, Scott. Can you hear me too?
Oh, okay. Yeah, sorry. I was playing around with my headphone because I thought.
No worries. Yeah. Go ahead.
Hard time hearing me. Great lecture. Thanks for all the information. So I'm curious if you've done studies where, okay, we know there's these overvalued markets that appreciate really rapidly and then also crash quite rapidly during recessions and following recessions. And then there's these other, like you pointed out, like the middle of the country, like North Dakota, South Dakota, Nebraska region, that's just kind of almost flat through recessions, it appears. So what I'm wondering is just on a longer horizon, like let's say, I'm from Phoenix. So let's say you bought a home in Phoenix close to the peak and then held it for 10 years compared to you bought a home in Nebraska close to the peak and you held that for 10 years. We know the value of that home will be dramatically lower in the short term in Phoenix because of what's happening during these cycles. But over a long enough horizon, because these markets are stronger and the fundamentals are stronger, does it catch back up and then surpass the more flat markets? You see what I'm saying?
Yeah, I mean, that part is right, but that part is, I had it, I thought we've spoken on that one actually before, right? Because that part is like, look, is right, this study here. So that part is, so Phoenix is 48% right now. So Phoenix is 40 to 50% range of overvaluation. If you buy Phoenix now, 10 years ahead likely would have worse appreciation than if in those what you call middle of the country states. That is what happens. So it seems like cycles are very, very long. But again, this is not saying that, to your point, I know you're thinking like, Phoenix has got all those strong fundamentals. That's true. It takes a really long time. So after those 10 years, perhaps Phoenix again is going to be on top. And that's what happened with Florida before. But like if you look at Florida, if you bought Florida in 2006, like, do you know, like in 2020, beginning of 2020, prices in Florida were still slightly below the 2006 peak. 14 years later. So it just takes a very long time. So the answer to that, I know, like, I don't want to give you like an answer kind of that you don't want to hear maybe, but the answer to that, like my perspective, and that's kind of what I've been trying to kind of like impose as a mindset shift, if you will, like on some people, that actually does take a long time. And it's not what people think, oh, those markets decline, and they decline kind of sharply for a brief time, let's say 1-2 years, and then they're gonna just explode and they're gonna be the best market again. It's not what the data suggests, because 1990 was an extremely mild recession. There was no reason for any of those overvalued markets from the recession standpoint that they perform so poorly 10 years ahead. But it's just the recession is a big trigger. The market cycle kind of resets, like you go into a new market cycle, and it's really, the answer is yes, they underperform for like a decade. That's what this table seems to suggest, because it's really, this table is like, you have 1 year ahead performance, 2 year ahead performance, 3 year ahead performance, every 10 years ahead, at every time point, and then every level of valuation, and it's almost perfectly ordered. So there's something there, it's not just like looking at numbers and having data. It's also like, what is the intuition? Like, why do you get a table that is like perfectly ordered in both directions? And it's just because, like valuation is kind of, overvaluation is a real thing. If you have real estate, is fundamental, it's a very real fundamental asset that's driven by people's incomes and so forth. And the other thing actually I want to say, like, because I know you mentioned like, oh, it's typically, and I know it ends up that more often some Midwest states are not overvalued and so forth, but actually there is no, these things change. They're different every time, because let me show you, like, for example, global financial crisis. So ahead of global financial crisis, Texas was undervalued. Texas was 5% undervalued. So now Texas is the booming market now. Texas wasn't that booming then, apparently, because it was undervalued. And Texas, being 5% undervalued, it only declined 4%. So Texas was right with those, call it, stable markets then. So it's not, there's no like, you shouldn't kind of have like prejudice that, oh, it's always Middle Eastern, Midwestern states or something. Not really, because for instance, on the other hand, here's another exception, like Michigan was very overvalued, and ahead of Gulf, or relatively, okay, like 22%, and it declined a lot. We declined even somehow like more than its overvaluation, like 29%. And Michigan is kind of thought of a relatively stable market. A lot of markets in the Northeast, they kind of are too small to show on this table, but New Jersey declined a lot. New Jersey was declined close to 25%, and it was overvalued actually a lot. And so Northeastern, ahead of global financial crisis, some Midwest, few of them, and quite a few Northeast markets were actually overvalued, and they declined. And Texas, for instance, was not. So it's really, it's not like only this perspective of having those booming markets and so forth. Now it appears that if we look at now, the big declines right now are likely to be California, Nevada, Arizona, Florida again. In California, Nevada, Arizona, Florida were the big declines back then. So they do seem to coincide. California is for different reasons. Like I discussed, it's not overvaluation. California seems to have some serious population issues. And so that's like, so just 1 second. But I'm just trying to find, I just don't have the state table right now in front of me. No, it's here. So so now like Arizona, Nevada, and Florida, let's say, are still in the list. And California is not very overvalued, but it's got like those issues of eroding fundamentals massively, and that seems to be affecting it. And so it's different every time. Look, Idaho is another example. Idaho is the biggest growth market this cycle. It's really different every time. It's a huge growth market, the biggest appreciation anywhere, bigger than Texas, bigger than Florida. But Idaho ahead of, that's where Idaho is now, 63% overvalued. Ahead of global financial crisis, Idaho was what? It was, well, there was overvaluation, okay, 25. Apparently it was back then. But again, I mean, yeah, there is, I would say there is a correlation. There is a tendency for some states, it seems to be, but it's not really what we expect. Could be that next cycle, Northeast and the cold states could be overvalued. You never know. It's possible. Maybe people will run away from too high insurance costs to the South or things like that. So you never really know in that regard. But to your question, again, I just want to mention it's just not a short timeline. It's like if you buy something, again, if you buy something that's 50% overvalued, it's gonna affect you for a long time as far as appreciation. That's what this says. Like 50% overall, you're going to be at least low degrees of appreciation, most likely, even if we get a very mild recession. And in fact, the milder the recession, the longer could be your decline duration. Like the highest decline duration in this table is the most overvalued range in the mildest recession, right? In the mild recession, most of our range, 6.5 years for declines to happen, and they're very small declines, 14%, and they're dragging like stagnant, dragging for 8 years. Just saying kind of like what the data suggests. So I don't know, that's kind of what I see. And it is interesting because I wouldn't expect, like when I did like this study, I wouldn't expect, let's say, the most undervalued range, less than 10%. It appears it's beating everything else, because those are markets that they really haven't done well. They really didn't appreciate. They're weak in fundamentals. So even the weakest in fundamentals markets seem to outperform the rest, because apparently fundamentals just stop mattering after a recession. All those, whether Phoenix is strong or Chicago is weak or whatever, it stops mattering after a recession too much, because all those fundamentals, they compress. Income growth is not that high either way. And they kind of compress. They come to, let's say that Phoenix is still 10% ahead in growth in over a few years, let's say, compared to others, but the overvaluation gap is so big, of the order of like 60, let's say, from 50% to -10 or something, is, let's say, 60% gap, and just too big of a gap to overcome. So this kind of the intuition, I don't know, at least that I have or that I see for this. So no, it kind of takes a long time, but again, it's not saying also that declines are going to be big or anything. This, whether declines are going to be big, I mentioned this earlier, is just economic forecasting, whether the recovery is strong or is not strong. If you get a strong recovery, something that's very overvalued will decline very little. Like take a look at like these declines here were very mild. We could get this scenario now. You never know. It's possible. Let's say 50 to 60% overvalued, only 14% decline. Now it appears we already, if we look at the metro areas, Austin is already at close to 9% of that. So let's say Austin is at the 60, Austin was 60+% overvalued, right? So let me just show like here. So Austin, 62% at the peak. So 62% at the peak, and then it has, call it roughly, let's say it's like this roughly range, right? And so in the mildest, one of the mildest for real estate recessions like this one, that's a market like that could have declined roughly 15%, only 1.5. We could get that. It's possible. I don't know. So it seems like already, But again, this is zero data. This is a different data set. So 9% decline in zero is not the same as a 9% decline in FHFA governmental data. That one is even smoother. They get like smaller declines and so forth. But in zero, okay, they're already at like 9%. It's all very early. I think it takes like a long time for things to be. But again, there's nothing. I don't think there's anything scary about any of this, because it's not like you need to get big declines in very overvalued markets. It's just to understand that it affects your performance. So there's like a relative underperformance. This is the biggest, to me, the biggest conclusion kind of like from studies like this. It's not so much, oh, you would necessarily kind of get hammered with a very big decline. Not really. It could be super mild, just like here. But either way, that market kind of suffers on a relative performance basis. And that is why, and so like when I did like this lecture, and then like one of the conclusions, and I think like Scott was on that one, actually, like in one of the conclusions was, okay, so that suggests because we don't have any recession declared now, right? So we can't even like speak to some of this too well, because there isn't a declared recession by NBR. Let's say that has actually happened. But let's say presumably we expect it at some point to happen. Could be in 1 year or whenever, or 2 years, or we don't know, right? And so, but if it did happen, what this table they are suggesting, this study suggesting, is that actually Midwest and Northeast are very likely to underperform. And I know it sounds like weird and crazy, and Northeast with all its heavy regulatory issues. And I'm doing deals now in the Northeast, and like some people were kind of skeptically, but it's not because, I'm actually, I search for deals to the South. I search for deals to the Midwest also. But to the South in markets that are not overvalued. So not in Florida, not in like, they're like other ones. And so, and so it does suggest that if we get even a milder recession 10 years ahead, it's extremely likely, if you think of the broad regions, Northeast, Midwest, South, and West, the Northeast and Midwest do outperform. Doesn't mean they would be like the top performers next cycle, not necessarily. Could be that next cycle again is to the South, but it's just after those 10 years. And, then they kind of start picking up, just like Florida last cycle. And so what are, let's say, some MSAs that are, how to say, well, do I have it here? Maybe not. Let's see, some metro areas that one can invest in that are, I can show you, let's say, that my company has been looking at from this perspective, from the perspective like lower recession risk. And so just a moment. So this is, okay, this is fine, actually, it's good. This is right at the peak of the market, it seems. I mean, I don't know, let's see where the peak of the market is going to be, but based off some of the recent declines, let's say, right at the Q2 of 2022. So that's perfect, actually. And so these are like some undervalued MSAs that are not like super attractive. And then the overvalued ones that have been very attractive, like that I've already mentioned. And so if you want to, let's say one took the region of West, let's say one took the West. So can one invest somewhere? Now, California, let's take out California, because California is very confusing because they just have like the whole population situation there. Other than that, you take the whole region to the West. How many MSAs are there? So, okay, I'm not able to see underneath in Excel, but so let's say like 61 MSAs. Almost every single one is overvalued. 54 of them are overvalued. Almost every single Western MSA is overvalued. Okay, if you went to invest in New Mexico or Alaska, for whichever reason, Sierra Vista in Arizona, I know someone who is doing a project there. So very few exceptions, but generally, from my perspective, I don't know, I don't invest in the West. So that's like that. But then if we take, for instance, the South, there are markets to the South that are perfectly fairly or even undervalued. Some of them are in the Carolinas and Georgia even, which are thought as very trendy states. But they're not actually, they haven't appreciated that much. The majority of those states have performed just like the Northeast, and they have like few exceptions of, they don't have broad-based growth. They've had like very narrow-based growth. Unlike Florida, which has extremely broad-based growth. So if you take, let's say, if we took Florida here, and where is the overvaluation in Florida? every single MSA in Florida, very overvalued. There's, from my company perspective, the kind of some of the things we discussed, so I don't look at Florida. But say we take Georgia and the Carolinas. So now suddenly there are some areas which were, from a valuation perspective, are actually quite investable. So those would be Greenville, North Carolina, Goldsboro, North Carolina, Columbus, Georgia, Warren, South Carolina, like markets like that. So a few of these markets are actually fairly valued. So one can invest to the South, and then, but the South has many more markets actually that are investable. And so, for instance, so many of them are, so let's say Louisiana, places like Baton Rouge. Let me try to maybe I should pick like bigger cities only, but okay, let's say Louisiana and Alabama, for example. So Baton Rouge is fairly valued. So all of the markets there, from this perspective, they wouldn't carry much recession risk. Again, I know those would not be the trendiest markets that normally one follows, but still it's to the South. There could be that they catch some pattern later. Let's say, who knows? And especially like I mentioned before, like Georgia and Carolinas, because there's so many people, there's somehow like a pattern, right? That, okay, oh, we can invest there. They're like booming states. I don't know, because they haven't appreciated much. Like certain markets, there are like 2-3 markets in each have appreciated much, but the rest markets just haven't. And well, that's why though they're not so overvalued. And so one could invest there. Then okay, let's say the Midwest. So the Midwest is kind of interesting. So it appears that the Midwest is now with commercial investors seeing negative rent growth in some other markets. They seem to be kind of quickly, at least on LinkedIn, I see like readjusting to the Midwest, it seems, and not the Northeast, let's say. And so in the Midwest, there are various under fairly valued markets, and there's some overvalued ones. So Kansas City has been getting more of popularity recently, and it is kind of on the more overvalued side by Midwest standards, not too much. And but other than that, from 94 MSAs, roughly about half of them are under to fairly valued. And then in the Northeast, Northeast, obviously, it's all kinds of regulatory issues there for sure. But the Northeast, so like 42 undervalued, about 2/3 of the metro areas are under to fairly valued. Places like New York City is fairly valued. Scott mentioned this before. So the New York City MSA is right around 3%. It's very expensive, but it's not overvalued. Now it has population issues, so it could be risky to invest in places like that with suburban trend. So because there are population issues and it could decline.
Hey, Stefan, Richard made an interesting comment in the chat.
Yes,
check that out. Right.
No, they are not the states with the lowest household incomes. Because, Richard, for instance, the very low growth states, they have higher household incomes. Not only this, their household income growth tends to be higher. If you track income growth, there's very high income growth in the Northeast. There always has been. In spite of that, real estate price appreciation in the Northeast does not happen. So household incomes it's a very interesting thing. Like a lot of where investors have been going this market cycle is more driven by population, not income growth. Income growth is stronger, is very strong in California. It's very strong in New York State, but they don't appreciate much because income is not enough to predict purely prices. And so it will not limit rent increase and equity gains, because equity gains, all those fundamentals do not matter after a recession. The extent to which they don't, it's just it appears just insane. It's just the fact that you can get like a table, like again, like this one. What that's telling you, the fact that you can have like the most depressed even in fundamentals market outperform other ones, it's just because fundamentals don't matter much after a recession for some time. They compress. You get those markets are still stronger in fundamentals, let them be stronger in fundamentals still, but it's just not enough to compensate for the whole high degree of overvaluation. So this is, I mean, if you want to like speak, Richard, if you want to like, I'm not sure if you wanted to just kind of speak up, maybe it's easier to kind of discuss this, but yeah, so household incomes, income is strong, not in the booming markets, actually. Just pointing this. Income is very strong in precisely the opposite of the booming markets. So, but they have population growth, generally. And the rental increases, now rental increases, it's complicated. It is really complicated because it's like all the thinking, I feel like usually like most of the time, real estate investors have a thinking on the fundamental side. But it is the interplay of fundamentals and prices. You have to always be thinking of the two together. And so, okay, if there's rental increases, the same argument for rental increase was constantly there for all those booming markets. But as we see, they're now seeing negative rent growth. So it depends if it gets to be too much at some point, right? And rental increases have been strong in some markets in the Northeast. Again, like I don't know, not to be mentioning examples, a deal that I'm looking at now has some of the very strong rent growth, like top decile nationwide, and it's a market in the Northeast. So it's not always like there is a lot of like stereotyped thinking also going on about this thing, and it's not. There's no low recession risk markets are just the markets that are low recession risk now. They're not that they inherently would always be low recession risk. Like I mentioned, again, you could have bought Texas in 2006, and some people did, and they did really well. And they had like incredible deals during the global financial crisis. It just depends. Like again, like what are you going to buy now? Let's say to have that. We don't know what's going to be the next Texas. And so but you have to kind of stay protected in a recession. So that's kind of my perspective.
No, those are good points, Stefan. Yeah. I certainly appreciate that. And it is complicated, as you mentioned earlier. It's not just a single metric like household incomes. I was really referring to the first states you showed with lowest recession risk, Louisiana and Alabama. I think they were those cities in those states. But obviously, the premium that a buyer would put on a marketplace, it does have a lot to do with their economic drivers like job growth and population growth, but also regulatory issues, certainly rent control and whatnot, or just their desirability to millennials or where job creation's occurring. So your points are very valid when you're talking about the Northeast with higher incomes, but they have higher regulatory issues, rent control, and things that maybe keeps their equity gains from occurring. And I think you're right on when it comes to recessions. Probably equity gain is not something that you're looking for. It's more preventing the big declines and the loss of equity more than anything. So all of those are spot on. And I think we're fully in agreement on those points. There's always distinctions that I might have taken a small slice of what you were pointing out there. So we're all on board.
Right. I mean, yeah, I mean, I think, but we can take the perspective of also just appreciation, right? We can take the perspective of where would we, if we want to invest now, where are we going to model the highest appreciation? And that's like, I think that's the question that most people are posing, where they say, okay, if we get a small decline in a recession, but then where are you going to get the highest appreciation? And again, like, I think what this study, for instance, like this one that I did before suggests is you would get it in the Midwest and the Northeast. So any thinking of, oh, those are your appreciation markets, like West and Texas and Florida, I don't think so. Not if you buy them at 50% overvalued. And so that's kind of like this. But yeah, those are good points. And it's also the other thing is, if you have like some of the fundamentals like Richard that you mentioned, right? In terms of okay, let's say a market has regulatory issues, negative kind of fundamental, and you have or population is not going well and all that stuff, and let's say you have like a very strong, again, like the important thing I think to understand, like for fundamental studies like this one, is that all that stuff is already reflected here. So if you have like, again, if you have the discussion about Austin or again, like whichever, like Boise in Idaho and so forth, if we have like this discussion, like, and then the other side, let's say like the counter argument being, oh, but they're very strong in fundamentals, in income, population, let's say population, income, housing supply, the interplay of those, right? But sure, but that's already exactly reflected in this model. That's exactly what this thing is modeling. So if Boise was extremely strong in population, income, housing supply jointly, the three of them, that's exactly what's reflected here. But again, the issue is that's exceeded now. And then the other thing is it doesn't have to be exceeded. I know like some of you may say, oh, just because it's a very booming market, it's going to be exceeded. No, it's just because we got like the whole quantitative easing and inflation exploded. And then they went overvalued. They were not overvalued as late as the beginning of 2021. That was reported by Bloomberg Economics. That was in my data. The US real estate was broadly fairly valued through Q1 of 2021, extremely late. 2020 was completely fairly valued. Again, there were the exceptions of Idaho, Boise, and all that, but it was fairly valued. One could invest in Utah and Nevada even, and so forth. Utah was fairly valued in 2020. It's not that they're inherently, or because they've had strong appreciation, that's why they're. Denver, there was a point that Denver was approximately fairly valued, and it was a top 5 appreciating city. So it's just like one has to track these things constantly and kind of be a value investor. It's my kind of perspective. Because you could have bought Denver at the very right time. One could buy Denver when it had very strong appreciation, yet it's fairly valued. So it's against, there is indeed, like, it's a little bit confusing because there is indeed a situation where towards the end of a cycle, how much something is overvalued and how strongly it has appreciated, it's highly correlated. That correlation one, actually, I even track it. So before, current correlation of like overvaluation and how strong a market has performed was, I think, around 87%. And then like it's kind of an indicator for if we are closer to the end of a cycle. Ahead of global financial crisis, that correlation was very strong. Ahead of 1990 recession was not so strong, I would say. So that kind of becomes at the very end. And again, we don't know, we still haven't got an actual recession. We don't know when exactly the end is going to be. But I kind of want to like stay aside from like kind of like the stereotype of, oh, you have inherently stable markets. No, Northeast was very overvalued ahead of global financial crisis, and Texas was undervalued. So they were not there. The next cycle, we could have all the cold states be overvalued, and we're going to be having this kind of conversation about all the cold states, and it's not impossible because it could be just like insurance costs booming and all the other climate issues or things like that. You know, it's not certain. So we don't know, like, in that sense. So there is a tendency, for some reason, there has been the last cycle. So Midwest has ended up being kind of a little bit shielded. But I mean, Midwest is not that, it's not undervalued now either. It's neither, a lot of parts of Midwest are overvalued. It's not great levels of valuation, I would say, even the Midwest. So it's really different every time. There's no, again, like, it's, think of like buying Texas ahead of in 2006. This is the perfect investment that one would want now. Now we don't know what's the next Texas at the current time, but this would be like the perfect type of investment. And it's also, there are very few undervalued markets now. So it's even more complicated than in 2006, because in 2006 we had like super overvalued markets and then a good number of undervalued ones. And now they're like very few. The overvalued ones now are less overvalued than 2006, but we have very few undervalued ones. And so it's kind of not too many places one can actually invest to be fully protected or have a very desirable situation. But again, 2006, another last thing, I know we're over time, sorry, we're gonna go, but another thing I wanted to mention is, if you think of like some of the issues in 2006, and again, like, nobody's thinking we're going to have this thing now, right? So now neither am I. But in terms of where people actually lost money, it's the example of, you know, let's say let's see Rodcliffe, right? Rodcliffe has like his lecture on again like losing 50 million after in single family housing. And I know again like commercial investors are gonna say, oh, could single family housing, that's where the risk is. I don't know. I don't think so. I think the risk could go either way. It could be very much on the commercial multifamily side. And even my intuition now, again, like I mentioned before, but it's purely intuition, purely speculative. I don't know. My intuition would be that commercial is more overvalued now than the housing market. And this data here is just the housing market. But okay. And so Rodcliffe, all his 1,000 single families, they were all in Florida. And so, I mean, that is like the situation when this happens. Now, on the contrary, Vinny Chopra. So Vinny Chopra did his first syndication in Texas. And it was not 06, he did it in 08. Okay, prices had a little bit decline in some markets, but declines on average were through 2011 in the majority of markets. Prices were dropping and dropping for 3 more years after 08. And so it's still a pretty bad time to invest. And so he did his first syndication. It was in Texas, in I don't recollect if it was Midland, Texas, or I had it written down, but an undervalued market in an undervalued county in the undervalued state of Texas at the time. It's extremely low recession risk. Nothing happened there. Prices didn't decline. And so his deal had like a very high IRR. So it's extremely important to select a market ahead of a recession according to this, because you want to be like Vinny Chopra in Texas and not Rodcliffe in Florida. So, okay. So if any questions, let me know before we kind of wrap up. Okay. Okay, thanks guys. Thank you for joining. So this is going to be on YouTube.
Appreciate it. Excellent presentation.
Thanks, Marcus. Thanks for joining. Cool.
Thank you.
Have a good night.